Welcome to the first part of Chapter 9, Monetary Policy Tools. So we have three conventional tools of monetary policy. The first are open market operations, or what economists usually call OMOs. They are decided by the FOMC, and they're done, as you know, by the Federal Reserve Bank of New York. Secondly, we have discount window. This is loans, and the amount there is decided by commercial banks, so they have to want to come and borrow money from the Fed for this to happen, and it's done by the regional Feds again. So not by one like Elmo's, but by all of them. Thirdly, we've got reserve requirements. They're decided by the Board of Governors of the Fed, so not by FOMC. That's interesting because the main part of monetary policy is, but the reserve requirements, the actual discount rate and the minimum reserve requirements are decided by the Board of Governors. And it's done by the regional Feds. So, of course, you know, if you have a bank in a certain area, say in Corpus, we're in District 10. So Federal Reserve Bank of Dallas is the central bank where our local commercial banks have to have an account, and they have to keep a minimum, the minimum reserve requirements in their account at the Federal Reserve Bank of Dallas. So what does the Fed use for its monetary policy? It uses what we call the Fed funds rate. So the next question is, well, what is the Fed funds rate? Fed funds rate it's a bit misleading as a term because it's not set by the Fed. The Fed funds rate is the rate in the market that banks charge each other to borrow or lend funds that are put aside as reserves. And how it works is that if I'm a bank and I have excess reserves one particular day, I can say, okay, my excess reserves, I'm going to lend them to whoever wants to borrow them overnight. And the rate at which I lend them to the other bank is called the Fed funds rate. It's an important interest rate for the Fed because it indicates how much reserves there are in the system. How much reserves there are in the system over and above what there has to be is a good measure of the amount of money, extra money that's slushing around in the system. So what economists call the liquidity of the system. So how much extra money there is there. So the Fed funds rate is a good indicator of the market for borrowing and lending those excess funds, those excess reserves, if you like. And those are, by the way, done usually overnight. So what we're going to do is set up a model first. Now this model is kind of not done in Brandl. This comes from the Mishkin book, but I've just copied the relevant slides over from the Mishkin book. So the way in which he looks at this is in terms of the demand for reserves and the supply of reserves. And of course you can build a model, but the demand and the supply are a little different from the demand supply kind of framework that we usually see in micro, and you'll see why in a second. So, you know, what we want to look at is what happens to the quantity demanded by banks for those reserves, holding everything else constant. Now, remember, the banks can borrow from other banks, in which case they do it at the Fed funds rate, or they can borrow from the Fed, in which case they do that at the discount rate. So overnight, if banks want to borrow money, there's two alternatives. You either go and borrow from another bank, or you go and borrow from the Fed. And on top of that, we have to consider that the Fed also gives interest on the reserves that are deposited with it. But we're going to come on to that in a second, because that determines excess, the amount of excess reserves as well. So, you know, why do banks hold excess reserves? Why do they hold them? Well, because they're a cushion. They're a cushion, so they're like an insurance against deposit outflows. So in other words, if the customers come to the bank and want to pull money out, the Fed knows that it's got the money there. And there are a couple of times a year when banks do hold significant amounts of excess reserves. One is at Christmas, obviously people coming and pulling money out of the bank account, and summer, when they tend to be going on holiday. So the cost of holding these is the interest rate that could have been earned minus the interest rate that is paid on these reserves. So the interest rate that's paid on reserves, excess reserves that the banks have, is I subscript OR. I don't know why he calls it OR. Not sure. I would think it would be better to call it ER, but he doesn't. He calls it OR. So first of all, let's have a look at the demand for the market for reserves, in the market for reserves. So we know that since the 2008, the Fed has paid interest on those reserves at a level that's set at a fixed amount below the federal funds rate target. So when the Fed funds rate is above the rate paid on excess reserves, IOR, as the Fed funds rate decreases, the opportunity cost of holding excess reserves falls and the quantity of reserves demanded rises. So in other words, the IOR is like the kind of fixed amount, because why, if the interest rate, to lend to someone, to borrow, interest rate to lend is higher than the interest rate the Fed is going to give you, then obviously you're going to lend that out, right? If it goes down to the amount that the Fed gives you, why would you lend it out? You might as well just keep it with the Fed. So the federal funds rate then cannot fall below, if you think about it, if you're in the market, you're not going to lend out money at a rate that's lower than the Fed funds rate. So we have a downward sloping then demand curve that then becomes flat or infinitely elastic, we would say, at this IOR. So the demand curve slopes downwards. So in other words, the demand for reserves falls as the interest rate falls. Why? Because, why have those reserves available to lend if you can get a reasonable rate at the Fed? And of course, they become infinitely flat at IOR, the amount that the Fed actually pays. What about the supply of reserves? So there's two components. There's non-borrowed and borrowed reserves. The cost of borrowing from the Fed is the discount rate. Borrowing from the Fed is a substitute for borrowing from other banks, as I said earlier. So if the Fed funds rate is less than the discount rate, so in other words, if the Fed funds rate is cheaper than what you can borrow from the Fed at, then banks are not going to borrow from the Fed. They're going to go into the private market and they're going to borrow reserves from another bank. So borrowed reserves are going to be zero. So supply curve is going to be vertical. As FF rises above D, so as soon as the federal funds rate goes above the discount rate, the banks are not going to, the banks are not going to borrow from other banks at a rate above the discount rate. Why should they? They can borrow from the Fed at the discount rate. So banks are going to just go directly and borrow from the Fed. And if IFF goes above ID, so if the market rate goes above what they can get from the Fed, then you just borrow from the Fed and relend it at the Fed funds rate and make the profit for the difference between the two rates. So the supply curve is going to be vertical at the non-borrowed level, and then go perfectly horizontal at ID. So in other words, it's going to look something like this. So the demand for reserves is this downward sloping blue line here. And when it gets to IOR, it's going to be horizontal. So in other words, as interest rates fall, people want to borrow more reserves. So up to a certain point, and the point is where the interest rate that the Fed gives you for those reserves. Why would you borrow them? I mean, we could just stick it in. Why would you lend them? So why are they borrowed? You just stick it into the Fed. So that's why it becomes horizontal at IOR. On the supply of reserves, we go to the non-borrowed reserve level because that's not what's borrowed, and anything above that is going to be borrowed essentially. And it will be a vertical supply curve which goes horizontal at the discount rate. Why? Because the Fed funds rate is never going to be above the discount rate, because who would borrow at a rate higher than what the Fed will lend you at, and that's the discount rate. So in other words, what that does, if you think about it, is for the market rate, the Fed funds rate, it basically creates an upper level, that's the discount rate, and a lower level, the rate of interest on excess reserves, that the Fed funds rate has to kind of fluctuate between. So let's look at a couple of examples. First of all, let's say we were at I2FF, so that's the upper blue dotted line there. Well, at that rate, for the Fed funds rate, we got an excess supply of reserves compared to how much people want to hold, or how much wants to be borrowed, I should say. So that's the gap there. So there's an excess supply of the reserves, and there's more supply compared to what people want to borrow. So that means that the Fed funds itself is going to have to fall until it gets to 1, in which case the Fed funds rate is in equilibrium. If we were at the lower level, so IFF1, then you can see that at that interest rate, the demand for those reserves is higher than the actual reserves that are available. And so that means that to clear the market, the interest rate must increase. So that pushes the interest rate, the Fed funds rate, in other words, back up towards IFF star. So that's the basic model. As you can see, it's like a supply-demand model, but it's a bit weird as a supply-demand model, isn't it? It's a bit weird in the sense that the demand curve and the supply curve are both kinked, and explaining them is quite difficult. But you can see there's a demand side to the reserves and there's a supply side for the reserves. The idea of the downward sloping there for the demand for the reserves is, of course, as it gets cheaper to hold reserves, then of course there's less of an opportunity cost. So you're giving up less interest if you actually loan that money out, so you don't mind keeping it with the Fed. So let's look at the tools of monetary policy now and how they affect the federal funds rate. So let's say we have an open market operation. It depends on whether the supply curve initially intersects the demand curve at its downward sloping section, or it intersects initially on the flat section. So an open market purchase, remember what this means. The Fed goes in and it buys bonds. Buying bonds pushes more money into the system, but the way in which it works is it buys the bonds from the banks, usually, and then deposits money in the bank's account at the Fed. So the reserves, the excess reserves, increase at the Fed. So what we should expect to see is that that supply of reserves curve shift to the right. That's what we should see. Why? Because the amount of reserves have increased because the Fed has purchased bonds. So let's have a look at what happens. What happens depends on where we were initially. Let's just go to the diagrams here, which are here. The explanation is in the two previous PowerPoints. So let's look over into the first case where we have an intersection which was on the vertical part of the supply curve for reserves. So say at 1. In that case, the open market purchase shifts the supply curve to the right. That causes, first of all, an excess supply of reserves because there's more reserves in the system. That pushes down the federal funds rate. You can see it falls from IFF1 to IFF2. Now let's look at the right-hand diagram, which of course is a kind of a niche case. It's not usual, but it can be the case. If the Fed funds rate is already very low, in other words, set at the rate at which the Fed pays on excess reserves already, then increasing the amount of reserves in the system is going to do nothing, because we're already down at the kind of maximum or minimum, I should say, level for the interest rate. So the interest rate isn't going to fall any further. Why? Because no one's going to lend out at a rate lower than the amount that the Fed gives you on the excess reserves. Why would I lend to a bank that's more risky than leaving my money with the Fed? Yeah, it doesn't make sense. So as you can see, the rightward shift in the supply curve has utterly no effect on the Fed funds rate in this case. That's basically in the previous slide what that talks about. It talks about those two different cases, the last two. Now, the third case here is discount policy. And this is where we have a lowering of the discount rate. So what's the effect of a lowering of the discount rate? Well, if we were at IFF1, the discount rate comes down. All that means is that that flat part of the supply curve comes down. Why? Because what it means is that the Fed funds rate isn't going to go above the discount rate, simply because no bank's going to borrow from another bank at a rate higher than what it can borrow from the Fed for. So all it does is push that down. The Fed funds rate was below where the discount rate ends up anyway, so it doesn't affect the Fed funds rate. Now let's have a look at a case in the right-hand side where it does affect discount lending. In other words, borrowed reserves do increase. So here we have an initial case at 0.1. The Fed funds rate then comes down, but that has to put discount rate, comes down, but then that has to push the Fed funds rate down as well. So both move down. So from 1 to 0.2. In other words, they move down the demand curve. That means borrowed reserves increase. That means there's more lending going on in the Fed funds market. Non-borrowed reserves, by the way, why it starts there is that's the minimum reserve. You can't kind of lend those funds out. They have to be kept at the Fed. So it's anything above non-borrowed reserves are the excess reserves. So BR and BR1 and BR2 there are the excess reserves, if you like, being lent out in the Fed funds market. Now let's have a look at a change in the required reserves. So this would be basically in the amount of reserves that banks have to hold. Now the amount of reserves that the bank has to hold, as you've already seen, it is equivalent to non-borrowed reserves as well. But that is the case in this diagram. Now, which curve do we shift though? Well, we shift the demand for reserves. Why? Because those reserves suddenly there's a greater demand because banks have to fulfill their minimum reserve requirements. What's that going to do? It pushes up the rate from the Fed funds rate from IFF1 to IFF2. So it increases the reserve requirement, causes the demand curve to shift to the right, and that pushes up the Fed funds rate. Now, this one's a kind of a real niche one, this last one. What happens if the interest rate on reserves changes? So in the first case, if we weren't at one of the kind of corner solutions, so ID or IOR to begin with, then increasing IOR just shifts up that bottom segment of the demand curve, and it doesn't change the Fed funds rate because the Fed funds rate wasn't at the or between the change, the old level for the excess reserves interest rate and the new level for the excess reserves interest rate, so no effect. Now in this case on the right hand side, there's a rise in the interest rate on reserves from IOR1 to IOR2. That pushes up that flat part of the demand curve. And that raises, in this case, the federal funds rate from IFF1 to IFF2 by the same amount to the same level as the rate paid on excess reserves. So the supply and demand analysis that we've done shows that, the Fed, what the Fed's done is basically it sets the discount rate and it sets this interest rate on excess reserves. And what that essentially does is to set a band over which limits over which the Fed funds rate can operate. So it limits those fluctuations that might occur otherwise in the Fed funds rate. And how the Fed funds operating procedures limit fluctuations in the Fed funds rate. You can see the demand for Fed funds might shift around, but the Fed funds rate is only going to go between ID and IOR. It's not going to go any further than that, even though the actual demand might swing quite wildly for reserves. So it basically limits the fluctuations in the Fed funds rate. How often do you see the Fed funds rate up at the discount rate? Not often, but you do see it, and sometimes it goes above for a while. Not for very long, because you can see from the logic here, it shouldn't be, and sometimes it goes right down as well, but it's not going to go below the interest rate on excess reserves. So during normal times, the Federal Reserve uses these three tools of monetary policy: open market operations, discount lending, and the reserve requirements, to control the money supply and interest rates. Many interest rates are tied to either the discount rate or the Fed funds rate. So those rates are very important for the rest of the interest rates in the economy. And those are the conventional monetary policy tools. Now, if we're looking at open market operations, there's some details that I'm going to go through now. The first is the idea of open market operations being of two types. The first type of open market operation is where you're buying or selling government bonds, as the Fed, in a permanent fashion. So what you want to do is change the money supply permanently. And those are called dynamic. Defensive open market operations are open market operations where you expect to reverse what you're doing now. So in other words, you might want to expand the amount of liquidity in the system for Christmas. So you might want to do open market operations for Christmas, but you're going to set it up in such a way that you can reverse it, usually through some kind of repo, by the way. But anyway, we're going to come on to what a repo is, but that will be a defensive open market operation. So a temporary fluctuation, a temporary change in the level of the money supply. Another example where the Fed does this as well is tax season. There's so much money flowing into the Treasury's accounts with the Fed that it expands the amount of liquidity there. It takes liquidity out of the system as people are paying the government, and so money flows out of the system. So the Fed often comes in to add liquidity to the system during tax time, because they realize people are going to be emptying their bank accounts to pay their taxes. Primary dealers. They do open market operations. They usually deal in government bonds, of course, and the the Fed's operations are directed, as we already said, by the Federal Reserve Bank of New York. There's a trading room automated processing system that gets involved in those bond trades, and some of them are repurchase or repos. So that's where the government might sell bonds, buy bonds, and then on an agreement to repurchase. So whoever sold them the bonds, they would have to repurchase them later. So those typically would be defensive open market operations, not dynamic. And then there's match sale purchase agreements. where you can do a sale and then a purchase of those. So that would be the opposite of a repo agreement. Some people call that a reverse repo. That's where you'd want to contract the money supply rather than expand it. Okay, the discount policy and the lender of last resort. Now, the discount policy essentially is the lender of last resort. Why? Because remember, the Fed decides on open market operations, but the commercial banks are the ones that decide how much they want to borrow. So the Fed isn't really in charge of this at all. I mean, it's in charge of the actual process of it and the granting of the loan to the commercial bank, but the actual volume of loans is not determined by the Fed. It's determined by the people lining up, if you like, at the discount window. The discount window has its name, by the way, from the idea that banks would come along with their certificates, which were usually government bonds, and they would have them discounted. In other words, the Fed would take them and hold them as kind of collateral and basically put money into their accounts. So that's why it's called a discount window. And there are various forms of lending as well that go beyond that. The so-called primary credit. Now, primary credit is essentially, it's like a line of credit that each commercial bank has with the Federal Reserve. And that is sometimes is known as a Lombard facility, by the way. Other central banks call that a Lombard facility. So it's basically like a pre-approved discount rate loan that the Fed has for each commercial bank. Secondary credit. Now, if the bank really gets into trouble and maxes out on its primary credit, on its line of credit, if you like, then it can apply. So the primary credit is pretty automatic, right? It's standing, it's there. You can borrow at that rate. The Fed's not going to ask any questions. Secondary credit, now that is where you have to apply, and the Fed does ask questions then, and usually wants to see some kind of collateral against that loan. So that's secondary credit. Then the seasonal credit. There are often banks, and these are typically small banks in rural parts of the country, where the farmers in particular will be, borrowing heavily to buy seed, etc. And they will borrow from the bank, and the bank itself, will be basically serving mostly one type of customer, a rural farming type of customer. And they'll go to the Fed and they'll ask to borrow money from the Fed to get them through this particular part of the planting season. And then when the crops come in, of course, they can pay that loan back, or the farmers will pay the loan back, and consequently the banks will be able to pay the loan back as well to the Fed. Incidentally, there are lots of other lending facilities now, some of them which have started just in the last couple of weeks, that are part of this lender of last resort function, depending on what's going on. So the Fed has the option to add to these, as we're going to see, but conventionally it's just these few things. It's basically the primary credit, secondary credit, seasonal credit. Now, the Fed's function here is as lender of last resort. And lender of last resort means essentially if no one else will lend to you, or if the private market dries up for some reason, you can always go and get a loan from the Fed. So the Fed is always there. It is the lender of last resort to the commercial banks. And the reason why it's there, and this is really why it was set up in the first place, during, as you know, after the banking panic of 1907, when no one would lend to some of these financial institutions that were perfectly sound. And this is the raison d'etre, the reason really for it existing, the Fed. That is to make sure that if banks have sound finances, that they can actually get a loan, and that the financial system doesn't collapse because of there being no one to loan to perfectly sound banks. So the lender of last resort is to prevent those financial panics really from occurring. It does create, to a certain degree, a moral hazard problem, though, because sometimes banks come to the Fed and they ask to borrow money, and then essentially they're borrowing it not to get them over a hump, but they might be borrowing to try and make some money off it. So in other words, borrow at the discount rate and lend it out to a commercial customer at a lot higher rate than that. Now the Fed actively discourages that and threatens banks by saying, if you are caught doing something like that, we will not give you secondary credit. Forget it. So it's called moral suasion. So it's like, being ethical about it, and not going to the Fed unless you really need to go to the Fed, and not using those funds for commercial profit for those commercial banks. Okay, we've talked about two of the conventional forms of monetary policy. There is that third one, which we did the analysis of, the reserve requirements. There is a reserve requirement that's set by this Depository Institutions Deregulation and Monetary Control Act of 1980. It's the same for all depository institutions. Reserve requirements are equal to 0 for the first 15.5 million of a bank's checkable deposits, 3% on checkable deposits of 15.5 to 115 million. And this is for most banks, because most banks are big banks in the US, 10% on checkable deposits over 115 million. So it's effectively 10%. The Fed can vary the 10% requirement if it wants to between 8 and 14% under this Depository Institutions Deregulation and Monetary Control Act. The Fed rarely changes this. It's nearly always set at 10%. By the way, I would note that the 10%, I would note that the minimum reserve requirement, that's of 10%, as I said, is not changed on a frequent basis in the US, but in other countries it is. So other countries where they don't have a deep bond market, for example, where open market operations would be difficult as a means to do monetary policy, countries like China, for instance, China uses changes in the reserve requirements very frequently to adjust its monetary policy. So developing countries in particular make a lot more use of reserve requirements than we do in the US. In the US, we really have set that. I think it was set in 1984 at 10%, essentially, and it's not been changed since. Now, this is the new thing, and those diagrams reflect this new element here in this model that we did for reserves. But the Fed started paying interest on excess reserves only in 2008, during the financial crisis, in fact. Interest on excess reserves tool came to the rescue during the crash, as banks were accumulating huge quantities of excess reserves because it can be used to kind of raise the federal funds rate. So this was a way to put a floor kind of under the federal funds rate and to stop it being raised, was to basically pay interest on those excess reserves. And I believe the excess reserve rate, I think it's just been changed. I know it was 0.25%, but I think it's just been changed. I'm not sure what it is now, I have to be honest. Okay, so here we go through kind of the steps of what happened during the Great Recession. By the way, the Fed just lowered the discount rate the other day. So it was last Saturday. I think I sent you an article about that. So to prevent the collapse of the financial sector, the chairman of the Board of Governors announced before the market opened on Tuesday, October 20th, 2008, the Federal Reserve System's readiness to serve as a source of liquidity to support the economic and financial system. In addition to this extraordinary announcement, the Fed made it clear that it would provide discount loans to any bank that would make loans to the securities industry. The outcome of the Fed's timely action was that the financial panic was averted. So, in other words, the Fed basically said, we'll provide loans to anyone that's going to make loans to the securities industry. In other words, the industry that buys and sells bonds and stocks, etc., because most of those dealerships were getting into severe problems with the collapse in the stock market as well. Okay, what are the relative advantages to the different monetary tools, and why do we tend to use open market operations as our dominant monetary policy tool? And the reason why is that first of all, you need a very deep bond market, and we have that. We have a deep government bond market, deep meaning a lot of volume traded, so that the prices don't go kind of haywire at times. So that doesn't happen, and that's why we can use the open market operations very effectively. Why? Because we know pretty much, or the Fed knows pretty much, how many bonds it has to buy or sell to push the Fed funds rate around. And so the operations that it does are pretty flexible and precise. They're also easily reversed. So, you can say push the Fed funds rate lower if you want for a few days, and then pull it back up again, and can be quickly implemented. Now, think about if you were going to do that for the reserve requirement in order to change the amount of money supply in the economy. Well, you've got to change the reserve requirement. Every bank's got to then be informed. Then they've got to either liquidate some assets and all the rest of it. In other words, it has to go through the banking system. With open market operations, you don't. The Fed just comes in, it engages in some transactions in the bond market. The banks are none the wiser what's going on, and they don't have to kind of change the amount of deposits they have with the Fed or anything like that. They're automatically changed by the transactions that they do with the Fed, of course, in the bond market. The discount rate is less well used since it's no longer binding for most banks, and it can cause liquidity problems and increases uncertainty for banks. The reason why, and this has been the realization of the Fed in recent years, when banks borrow from the discount window, other people know about it. So if a bank is in trouble and it goes and borrows from the discount window, the Fed has to publish that. That's kind of public scrutiny of what it's doing with the state's money, so to speak. And consequently, that means everyone knows. So this it's kind of embarrassing to go to the Fed's discount window and borrow from the Fed. So the discount window remains of tremendous value given its ability to allow the Fed to act as lender of last resort, but there are these concerns about it, and you'll see in a second, how the Fed's tried to overcome those. So, as I said, now that by the way, we've kind of finished with the Mishkin stuff. This is the Brandl stuff. So it covers some of the same elements. So I'm going to kind of whiz through it, or maybe I'll do that in part 2. I'm going to do that in part 2. So let's stop here, and we'll pick it up in part 2. Thank you.